How are you? My name is Roberto Ori Randy, and we are going to continue in this course of Financial Accounting for Decision Making and Control at BlackRock Global University within its MBA program. Well, let's enter this third session where we will continue to delve into the field of financial accounting. In this regard, we will look at different aspects and some applications of this highly relevant field, which is financial accounting. So, continuing from the previous session, I will first talk about the balance sheet and the financial situation, or the financial situation of a balance sheet where there are different points or aspects to analyze. These aspects relate to, of course, how a company's assets are composed or structured in terms of their concentration in operational assets, what happens with working capital, and what happens with fixed, physical, tangible assets. And also, on the other hand, the structure of financing in terms of how its financing is concentrated, with debt from third parties. Also, the structure of liabilities, how much is short-term and how much is long-term, and how the financing structure aligns or does not align with the asset structure. Finally, how the company's equity is also structured. So, here we would have, for example, a balance sheet where we have current or short-term assets of 20, non-current or long-term assets of 80, and those 100 in assets. How are they financed? In this case, there are 60 in current liabilities or short-term liabilities, 15 in non-current liabilities, and 25 in equity. One might immediately notice, for example, that this company has 20 in current assets and 60 in current liabilities. That is 3 times the short-term liabilities over the short-term assets. And could that be a problem? Yes, it could indeed be a problem, because it could happen that current liabilities are, for example, essentially bank financial debt, which matures in 2 months, and debt with suppliers, which matures in 1 month, and current assets could include accounts receivable, which mature in 90 days, inventory, which may not be easily liquidated. Therefore, eventually this company could find itself in a delicate situation from a liquidity standpoint. And on the other hand, conversely, we have many long-term assets that are being financed essentially in the short term. So, it's a first look, right, that one could make a balance like the one we are showing. Now, if, on the other hand, we move to the income statement, this is no longer a snapshot like the balance sheet, but rather a movement, right? This is a flow. So, in this income statement, what we want to present is, in detail, the revenues that a company generates as well as its expenses. And to finally arrive at the profit or loss that this company has generated in the period we are analyzing, whether it is monthly, quarterly, semi-annually, or annually. And it is clearly complementary to the balance sheet. Unlike the balance sheet, which is a snapshot, this income statement shows, as we mentioned, revenues and expenses over a period, and then in the next period, it starts from zero. This does not accumulate, so to speak, over time, at least not annually. And also, on another interesting note, it is important to point out that this result will be reflected in the change in equity over a certain period. If the company has a profit of 1,000, well, that 1,000 will increase the equity by 1,000. If you have a loss of 500, conversely, this will decrease the value of equity by that 500. So, this income statement is structured in the way it appears here. We have the business income, the operating income, minus the costs of that operation. That gives a gross result. From that gross result, all administrative and selling expenses are deducted. This includes salaries and wages of the administration, rent, electricity bills, and water bills. Additionally, the depreciation of assets is also accounted for. That the company has that depreciate, and that goes to the original operational result. Operational result, or the profit or loss of my businesses during that period of time. To that operational result, on the other hand, non-operational income and expenses are added, as well as non-operational income and expenses. Financial expenses that come later, right? Or, if the company has a profit from a business that is not its main line of work, imagine a company that provides services and for some reason acquired a piece of land, and that land generated a profit when it was sold. Well, that would definitely be a non-operational income. So, the operating result plus income and minus non-operating income minus financial expenses will be the profit before tax. And from that taxable income, of course, we need to subtract the tax, and with that, we will finally arrive at the net profit or loss for the period. So, with that income statement, 1 should start to estimate or calculate certain results and certain indicators. Okay. Normally, these results, rather than in absolute terms, are presented in percentage terms, proportionally, in relation to sales. So one is the gross margin, which is the gross result, for example, income, minus direct costs, over operating income. For every peso I sell, how much do I earn or lose at a gross level? So it gives me an indicator that also has the advantage of allowing comparisons with other companies in the industry, with other similar companies, like whatever benchmark exists. Next, we have the operational margin, which is the operational result or profit or loss, right, divided by the operating income. So, as we were saying, we subtract all administrative and sales expenses from the gross result and deduct the depreciation of the assets to arrive at that result. And we did that based on the revenues, and it gives us this percentage indicator. This operating result is also called earnings before interest and taxes in English. That, in essence, is the profit before interest and taxes, presenting it in percentage terms. Also allows us to have a more. It is finer and more comparative with other companies. Then, very importantly, this indicator, which is interesting because it is not directly in the income statement, is avoided over operating income. Now, what is being avoided? Well, it is the profit before interest, taxes, depreciation, and amortization of intangibles. But why do we calculate it? Well, we calculate it because EBITDA, unlike net income, excludes those items that are expenses but are not cash outflows. In this sense, to arrive at EBITDA, we take the operating income and add, as we mentioned, depreciation and amortization. In a way, EBITDA is closer to the cash flow generated by the operation, by the business, since these two items, depreciation and amortization, are not cash outflows. So, this EBITDA to revenue indicator is widely used, and it is used to understand the company's ability to generate operational cash flows. So, EBITDA, as it comes out here, has the advantage of being a sort of shortcut to calculate an estimated cash flow or cash available that a company has, among other things, to pay its debts. Also, as we mentioned, it can be used to make historical comparisons of companies in the industry and provides information free from financial leverage, monetization costs, and taxes, which in some businesses, of course, are high. It is also used significantly as a multiple when valuing companies. So, for example, if an industry today uses an EBITDA of 8 times, it means that if the company has an EBITDA of 10,000, well, the company is valued at 80,000. So, of course, it is important from a valuation perspective, and using this indicator is important. On the other hand, we have disadvantages of the approach because, for example, there are industries where depreciation and amortization of intangibles are important already in 2001, and which is fundamentally associated with strong investments in fixed assets of capex. So, for example, if there is an industry where they need to make significant investments, because there are many technological changes or a shorter useful life, it is likely that EBITDA will not be equivalent or similar to the cash flow of the business. So, one must be careful when using it too enthusiastically in that sense. It is also important to understand that by not considering, for example, the company's debt, the information on the balance sheet does not provide clarity on what the bottom line, the net income, might be, because it can certainly be heavily influenced. Regarding this issue of financial leverage, it should be used, of course, because it is useful and more pure than operational results, but it must be done with due care. And then there is the net margin, which is the net income, the bottom line, over operating revenues. So, it is what ultimately remains available, from an accounting standpoint at least, for the company's shareholders for each unit sold. For every peso of sales, right, how much do I have in net profit? And that also, right, is used to see effectively, well, at the end of the day, between operational and non-operational and taxes, how much is left finally of results, and this net margin is generated from the income. So, for example, here we see a case of the company El Mall S.A. And we have these indicators. We say, let's see, this company has income tax expenses of 150, cost of goods sold of 10,070, financial expenses for interest of 210, sales revenue of 12,490, administrative and sales expenses of 7,060, other results of 380, depreciation expenses of 520, and finally, general expenses of 660. Can we organize this? Can it be ordered? Of course, if I am given these 8 items, and I have to order them, what do we do? Well, we can arrive at this result, right? Where the company generates a result, like the one we see here, where we ultimately regroup the different components of the income statement. And we have, first, sales revenue of 12,490. The cost of goods sold is 10,070. And that gives us this, first, gross profit of 2,420. From that result, or gross profit, we subtract all the items. These are administrative and selling expenses, including depreciation. So we have administrative and selling expenses of 760, general expenses of 660, and depreciation expenses of 520. What does this imply? This implies that we will have a total of administrative and sales expenses, that is to say, adding the 3 previous items, by how much? For 1,940 so. If I subtract 1,940 from the gross profit of 2,420, we will arrive at an operating profit and EBIT, earnings before interest and taxes, of 480. And if we wanted to calculate, except for some percentage indicators, well, for example, if you wanted to calculate the gross margin, what we would have to do is take 2,420 and divide it by 12,490, which would give a margin slightly lower than the gross margin, right? At 20%. On the other hand, if we take the operational profit of 480 and divide it by the sales, it would give us an operational margin that would be around a certain value, right? Limited except that we would have a value. That would be around 4% of 480 over 12,490, so that would be personal. Now, if we wanted to calculate the life, we would have to take the operational profit of 480 and add the depreciation of 520. How much would that give us? 1,000. In this case, a company with an operational profit of 480 will have an EBITDA that is more than double 1,000. Because we add the depreciation expense to the operational profit and arrive at that value of 1,000. Now, after that, we need to continue down, subtract the financial expenses, which in this case are 210, and add other results. Non-operational, 4,380. And this will lead us to or leave us with a profit before tax of 650. Operating profit 480, profit before tax 650. And if we subtract the income tax, according to the income tax rate in that market, we will arrive at a net profit of 500. And in this case, it just so happens that the net income is practically equal to the operational income. And there, right, we would calculate an indicator, for example, the bottom line, and it would show that the net profit as a percentage of sales is around 4%. Right. So, well, ultimately, as you can see, this helps me, right, to know, well, how efficient the company is. Are we efficient or inefficient? How efficient are we? How high or low is the productivity of this company? And therefore it is, or should be, right, a very useful tool for internal purposes, of course, for making decisions. For example, right, if our operational margin that we were talking about here is less than 4%, around 4%, it turns out that we know that companies in this sector should operate with an operational margin of 9%. There we have a benchmark, right? We have a comparison that should draw our attention, in this case negatively, and it should lead us, more than just drawing attention, to make decisions. It makes a diagnosis of why we have, for example, that business margin is low, and given that diagnosis, what decisions should be made. For example, streamlining administrative expenses, perhaps incorporating new technology to achieve a better gross margin, etc., etc., etc. So this is what seeks to generate an income statement for the purpose of analysis and decision making. So we return here to our analysis. We continue to move forward, right, with this course.